stabilizing out. So good morning, everybody. Thank you for joining the LaingBuisson launch of the market review for 2021. This is something that Avison Young has sponsored for many years now, and I'm very pleased that we're sponsoring it again this year. It is important research into the sector, and no more so than in uncertain times that we have at the present time. For those that don't know me, I am Ian Locke. I'm the Managing Director of Healthcare at Avison Young. I and my team have been in this sector for very many years indeed, and in many respects never has it been more challenging but more exciting than it is at the current time. We have a very simple agenda for you this morning. We have a talk by William Laing, laying out for us the latest research and some of what that means. And we also have, I'm very pleased to say, Dr. Victor Chow with us from Mansfield Advisors, who is going to also give a presentation on parts of the segments of the healthcare sector. I will follow them with a few minutes of observations on what we're seeing at Avison Young in the markets, in the transactional markets, and how that's reflecting itself through valuations, what the challenges are, and what buyers and sellers are thinking at the present time. And I suspect when we hear what William and Victor have to say, we will be confirming that much of what they're seeing in the research is actually being reflected in the marketplace at the present time, but we'll have a look and see whether there's a mismatch there or not. We will have 20 to 30 minutes, I hope, at the end for questions. So please do join in, use the question and answer facility on Zoom to do that. And I'll keep an eye on those questions coming in at the present time. And to those of you who've already given us questions, thank you for that. We have noted those and we'll weave those in, I hope, at the same time. But as new things occur to you, as you hear William and Victor speak, do please give us more questions. We're scheduled to finish on the dot at 10:30, so we'll try and keep to time. And so without any further ado, I'll introduce you to William Laing, who many of you need no introduction to whatsoever. William is an economist, the driving force behind LaingBuisson, which he set up in the late 1970s, so founder and chief executive today of LaingBuisson. William is a leading commentator in the independent health and social care sector in the UK. He regularly comments on sector issues. He's sought after by the media. He speaks at conferences. He has been invited to government select committee and to think tank organisations to speak on the sector. And the research of LaingBuisson is widely reviewed, read and listened to by the whole of the sector. So without further ado, over to you, William.
Right. Well, thank you very much, Ian, for that introduction. And it's a real pleasure to have Avison Young support us for a further year for the launch of the UK Healthcare Market Review. So, and we're delighted, of course, to have Victor Chow, who's going to be speaking after me. So what we thought we'd do is that the review covers an awful lot of areas, about 14 in total, but it would be too much to do everything all in one go. So I'm going to be speaking on the social care side, and then Victor is going to be speaking on the acute healthcare side, that is private hospitals and medical insurance. I should mention that we in fact have some data now on the latest medical insurance figures, which haven't been published yet. Actually, we're still in the process of analysing them. But what it does show is that perhaps predictably in 2020, late 2020, there was quite a large increase in subscription numbers for the first time for a long time. But I think that in a sense is predictable, but we'll look forward to hearing more on the acute side from Victor later on. So let me go on to the first slide. This is just a summary of market values. And we're going right away from private acute healthcare 6.8 billion, primary medical care, quite small, etc., etc. And then we go up to the right-hand side where we have the social care sectors, with the largest one being care homes for older people, then home care and supported living, and adult specialist care. So that's what I'm going to be talking about. So you see the total, we reckon, estimate this is around about 2019-20. We're talking about a total independent health and social care market size in the UK of £54 billion. So it's a fairly chunky sector, but divided into different segments, small and large. So let's have the next section. So as I say, we're talking about social care. So first question is, or we're trying to answer it, is how did social care operators fare after or during COVID? And I think it's fair to say that care homes for older people are the operators that have seen the most significant financial detriment, but not actually that great. The contrast to that will be home care and supported living. In fact, we launched our home care and supported living market report just last week. And for that, we looked at about approaching 70 statutory accounts, and looking at the strategic reviews, directors' reports within those accounts. Now, although most of those accounts were for the years 2020 and a few for 2021, nevertheless, they were signed, and the commentary relates to a date which was more or less when the second wave had finished, well into 2021. What that showed for home care and supported living, that there was virtually no financial detriment to the operators. To the extent that they had been financially impacted, they had received grants from government, which more or less made up for it. That's not, of course, to say they weren't under tremendous strain, which they were, and the staff that operate the services really rose to the challenge. And I think it's also fair to say that that in general, across the whole health and care, social care sector, the fragmented independent sector has performed incredibly well. But we're focusing really on the financial side, the operator side. So that's why I'm focusing at the moment on financial detriment. So really, care homes for older people, they were impacted by high mortality. They're impacted by lower occupancy levels, which have started to rise up again, but they're not back to normal yet. Whereas in the other social care market, adult specialist care homes, home care, they have not been as affected. Mortality rates were much lower because of the age profile. And interestingly, the home care, even for older people, the mortality rates were much lower. So COVID, it's a story about, it's a mixed story, but one where generally the sector has stood up extremely well to the challenge of COVID. And we're now looking forward, of course, to that not being repeated until perhaps the next thing happens. So let's go on to the next slide, please. So what I thought I'd just do is to look at profitability, because that's a measure of what's happened in financial terms to the operations. It looks a bit of a cluttered chart, but let me draw your attention to the figures for 2020, and there are two at the bottom, which are the yellow one being BUPA, year ending December, so that's year ending December 2020, which is well into the COVID time, and also the blue one, which is 4 seasons, that's also to December 2020, and both of them you'll see the level of profitability as measured by EBITDA as a percentage of revenue dropped during this COVID year, but not enormously. So it's not just COVID, of course, it's the whole financially challenging environment in which they're operating. And you'll see that both of those companies in that particular year were down to an EBITDA level of 10%, which I would say is pretty dangerously low, but not entirely attributable to COVID, but in part. What that also shows, of course, is that huge range of profitability, and the one right up at the top, which you'll see, which goes up to 43%, that is Avery Healthcare Group, which of course is very largely private pay. I should point out that in fact, that's, although it's March 2020, it's up to March 2020, so it doesn't relate to COVID at all. So let's have a look at the going from older people's care homes to younger adult specialist care homes. Again, a rather cluttered picture. There's a sort of general movement down, but insofar as we have the data that covers the period of COVID, there hasn't been any substantial decline in profitability. The only one that goes up to 2021, in fact, is Voyage, and they are sort of not very greatly changed from the previous year. The other thing, of course, to see from this chart is that overall the profitability of adult specialist care home groups is higher than older people's care home groups, which have been more impacted by the financial charges of low funding from central government. And just to complete the trio, let's have a look at the profitability of home care groups. It's a bit squashed, that slide, but what it shows is that first of all, no impact really of COVID, and also the profitability overall is fairly low. We're measuring profitability as EBITDA rather than EBITDA here, and in fact aggregate is around about 6%. So we're talking about fairly low levels of profitability, but not significantly impacted by COVID, but of course, yes, impacted by the general financial situation, challenging financial situation of public funding. So let's go on to the next one, if I may. And I thought really, rather than going into great detail about, exactly where we stand in terms of capacity and occupancy, etc., I thought I'd just talk more about the public funding for social care and what the Boris Johnson's announcement of 7th of September means. And in my view, and I think this may well be quite widely shared, to call the package, the September package, a step in the right direction is a fairly charitable description, because my own view is that really the sector has been shortchanged. It was built up as being something which was the important event in fixing social care, but in reality it was a package very largely for the NHS. So 36 billion over 3 years, that's 12 billion pounds a year. Out of that, only 5.88 billion has been earmarked for social care, and only starting in 2023. And most of that 5.8 billion will go into what's called system reform, which effectively means the subsidy to property owners, and not into expanding services or core services or prices generally. So rather disappointing. We will have at the end of October the 3-year spending review, and that'll be another opportunity for injecting more money into core services. But the clear message from the Treasury is that don't expect very much, if anything, for new funding for social care. So overall, quite disappointing in terms of central government pumping new money into social care. I think even more important than that was something which was not right up in the headlines there, but was put out by the government, their intention to implement clause 18.3 of the Care Act, with a view to equalisation of public and private fees. Now, this of course really only relates, or very largely relates, to care homes for older people, because that's where the private funding is, and that's where we know from data from ourselves and from the Competition and Markets Authority that private pay fee rates are about 40% higher than public pay rates. So it's difficult to see how the public and private fees can be equalized with only such a small amount of money, extra money, if at all, going into social care. So what this seems to suggest is that if the government is being serious about implementing 18.3, it is a really quite massive threat to operators of care homes for older people. I think that, firstly, that the devil will lie in the detail, that we could have a hard implementation of clause 18.3, in which local authorities would be instructed to arrange care if requested by private, who would otherwise be private payers, or you could have a softer implementation in which local authorities were not told that they must do it, but they may do it. But all of that is to come, and the detail of that will no doubt come out in due course. So I'd say this is a really quite massive threat to the older people's care sector, potentially anyway. So let's go on to the next slide. I just thought I'd say a little bit about how I see very, very briefly prospects for social care operators. So going into older care, adult specialist, and home care and supported living. So demand. Well, we know that recently demand for older people's care homes has been declining because of COVID. It was static for 10 years in the past, but for the future, I cannot see how it can be anything other than growing. As regards to demand for adult specialist care, that has been declining over a long period of time as services moved away from care homes into supported living, and that is we expect to continue. So future demand continues to decline. Home care and supported living both growing recently and growing in the future as well. As far as public pay prospects go, I put down older care homes as being uncertain. Well, all of them, in fact, are being uncertain. Looking at the private pay prospects, older people's care homes, I've put down as good question mark. And what that means is, bearing in mind what I just said about the implementation of clause 18.3, if that does take place in a hard sort of way, then it is very questionable. On the other hand, it is a soft implementation, then I think the private pay prospects remain, as they have been in the past, good for older people's care homes. Adult specialist care doesn't count because there isn't any private pay. Home care and supported living, good prospects for private pay, I believe, going forward. But finally, and I haven't talked about this at all, but I'm sure other people will wish to, staffing prospects, which are put down as simply problematic. And it's a very difficult bind to get out of, because social care is now based basically on low pay. But they're not the only low pay segment in the economy. We're talking about retail being low pay as well, hospitality being low pay. And it really is a much more general problem, I think, an extremely difficult one to get out of. So I look forward to any comments on that. So that's my presentation, and hand it back to the chair.
William, thank you very much for that. Interesting statistics as always. I wondered, just before we go to Victor, if I may, can I just ask if you have a feeling yet for how the care cost being capped that people will have to pay over their lifetimes is going to be put into place? What that means in terms of the cap? Is it being put into place in a way that the government believes that most people won't come up to that cap anyway, so it won't cost the government very much? Have you got a feel for any of that at the present time?
To some extent, it'll depend on which area of the country you're in, because prices are higher in the southeast and lower in the north. Also, it's quite likely that what the government will say is that it only counts, your spending only counts to the cap insofar as you're at public pay levels.
Yeah, okay.
And also you would have to be assessed as needing it. So there's a lot of detail there. But look, the long and short of it is that there won't be no one will reach the cap in significant numbers anyway for another 5 years, or 5 years after 2023. So we're talking about the long term. The one that'll come that will be hit quite soon will be the upper asset threshold, of 100,000, where a lot of people will go into that, particularly up in the north, where house prices are around about that level.
Okay, yes, thank you very much indeed. I mean, I think there are lots of things there, still some uncertainties, which I'll reflect on in the market, but much of what you've said, I think, is being considered very hard. I think one of the real worries that you've highlighted there is the clause 18.3 issue, and how that's going to impact markets. I think we really do have to wait and see. But let's leave it there. There are lots more questions, and I'll be reviewing those questions as they come in. So everybody, please do bring your questions forward, and I'll be looking at those whilst Victor speaks. So if I may, let me introduce you to Dr. Victor Chow. Victor started his career as an ophthalmic surgeon after qualifying, I believe, at Cambridge. But he left that to join McKinsey in 2000 to look at the business side of the healthcare sector. He then went on to develop a healthcare practice for a private boutique before setting up as a co-founder Mansfield Advisors in 2013, where he is now a joint senior partner. The firm is a leading consultant in strategy across the healthcare sectors, with a focus on corporate strategy and commercial due diligence. And Victor, I'll hand over to you, if I may, to give your presentation, and then we'll go into a full question and answer session. Thanks very much.
Thank you very much, Ian. Well, I thought that in the 10 minutes that we've got, I'll cover two main things. Number one, I'll talk a little bit about the insured market, the acute private medical insurance market, for about maybe 2 minutes, and then spend the remainder of the time talking about the prospects for private operators in healthcare. And I suppose, shall we go to the next page, please, Jade? At about this time last year, we were a bit worried about our sector, as I suppose all of us were, and we therefore commissioned a survey in conjunction with Vitality Insurance of 100 CEOs. And as you can see, we interviewed 41 CEOs from smaller companies with less than 50 employees, 39 CEOs from large companies of more than 250 employees. Most of the interviews were done by phone in order to get a good sample. Next slide, please. And as you can see, this slide just shows that we interviewed the really top decision makers. Next slide, please. And this slide just shows that we sampled a representative sample of companies throughout the economy. And I've got further slides to show that we interviewed people from all over the United Kingdom, and it was representative in any way. But I think that you can trust me. I think the interesting thing were the results, which are on the next slide. And when we asked, are you likely to reduce, increase, or have no change in the number of your private medical insurance policies next year, this is our result. 70% of CEOs said there would be no change. There was a small number of people, 12%, who said that they'll reduce the number of policies. And that was pretty much counterbalanced by the number of people, 9.8%, who said they'll increase their policies. And this was quite a surprise to us because, remember, we were doing this really only a month after the end of the first lockdown, and the economy was on life support, or at least many sectors were on life support, in particular retail, travel and hospitality. And, we thought that those sectors would be particularly hit. Now, on the right-hand side, you see, why of the 10 people who said we're going to have fewer policies, not surprisingly, the majority said that, well, we'll have less policies because we'll have less employees. We had an equal number of people who said that, look, the government has taken over private hospitals, what's the point of having insurance this year because we won't be able to get in, which was a fair point. But I thought quite a lot more people had thought about this than we had expected, really. We thought that, a lot of people wouldn't have quite sort of connected the dots there. Next slide. And the other thing is we asked them, have you decided to take a payment holiday or to defer payments? You may remember around this time last year, private medical insurers were saying, well, if you're in difficulty, we'll allow you to defer payments or take a payment holiday. And as you can see, 70% said we've made a considered decision not to do this. And 16% said, no, I didn't even hear about it. So, I mean, I think the picture that this shows is that in private medical insurance is incredibly resilient. Next slide, please. And I think William's latest figures show that the number of policies has actually been going up, which is, I think, very heartening. Now, the next section of my presentation, and don't worry, it's only 6 slides, I think, is with regard to private hospitals and what has been happening in private hospitals. And this slide shows you the number of A&E attendances over the last 1.5 years or so. And as you can see, first lockdown, big drop in the number of A&E attendances, less than half of the normal level. And when lockdown was lifted, that went up. But in the second lockdown, fell again, very, very precipitously. And as you can see, it was only in June this year that the number of A&E attendances reached the level that it was before. And I think obviously part of the reason that the number of A&E attendances fell down would be, well, fewer people moving around, fewer industrial accidents, fewer car accidents, etc. But that's not a large amount. I mean, in truth, a lot of people go to A&E with things like heart attacks and even cancer. And one does have to wonder whether, a lot of those people just did not attend and will attend at a later stage in the course of their illness. Next slide, please. Now, this shows our projections of the number of people on, elective surgery waiting lists. On the left, we have England. On the right, we have Scotland. I'll concentrate on England because obviously it's the bigger country. And our projection, our central projection is that by 2023, we'll have about 12 million people waiting on the elective surgery waiting list in the NHS, which is really quite remarkable. I mean, that's 1 in 20, 1 in 25 people in the UK, in England. And a lot of this estimate is that we think that the pathology, the people with pathology who did not present, in the last 1.5 years will come out of the woodwork and will need treatment. Next slide, please. Now, the next couple of slides shows our estimates of the level of clinical demand versus the level of supply. I mean, this is for everything, basically. The gray line at the top shows the number of outpatient attendances indexed to 1, which is in 2013. The line below that shows inpatient and day case episodes. And as you can see, those are very, very good correlates of what demand is in acute hospitals. But if you look at the measures of supply, full-time equivalents who are doctors and full-time equivalents who are nurses, the growth has just not kept pace. And essentially what this means is that, doctors are being asked to do more procedures, and especially nurses are being asked to do more procedures in the NHS. Now, you might well say that in the Labour years, doctors, perhaps there was a big expansion in the number of doctors and this was just catching up. But, I find this very, very stark. I think, the number of staff to deal with patients has just not kept pace. Next slide, please. This does pretty much exactly the same thing, but just in radiology. And as you can see, the number of CTs and MRIs, and I'll concentrate on the solid lines, not the dotted lines, which are projections. As you can see, indexed to FY14, the number of CTs and MRIs have increased, really quite dramatically. But the number of radiologists to do the actual reporting of the CTs and MRIs has increased at only half the rate. X-rays are flat. Next slide, please. So what does this all mean? I mean, I think in essence it means good news for private hospitals. And as you can see, this is the most recent data I can find for orthopedic surgery, which I'm sure most of you know. Orthopedic surgery is the specialty that really drives the profits in private hospitals. And as you can see, for these 4 specific hospitals, all just outside London in the same sort of region, you'll see that with COVID, procedure levels dropped dramatically. The hospitals were taken over by the NHS. Some hospitals were used for elective surgery, such as Nuffield Woking and Guildford. There wasn't a big drop there. What I suspect is that the local trusts were using them to do more elective surgery. Whereas if you look at the BMI Mount Alvernia, or the Mount, there was a much larger drop there. I suspect that's because the local NHS decided to use it more for cancer surgery, and therefore it was able to do much less joint surgery. But I mean, look at the trajectory though of the recovery. All mostly really between March, April, May, June this year, leveling off for July and August, which are traditionally slower months anyway for elective surgery. And I suppose the big question is that, will this continue? And my guess is that yes. I mean, that upward trend will probably continue going, perhaps not at quite the same rate of growth as before, but I expect it to continue going up. Next slide, please. And a lot of people ask us, and I think in some of the questions, can you tell me about a market which is actually growing quite dramatically? And I can think of 2, basically. One is NHS insourcing, and the other one is NHS outsource ophthalmology. And I've got a slide on the first one, NHS insourcing. Now, this may not be fantastic news for our private hospital sort of clients, because this relates to the people who supply full surgical teams to NHS hospitals to do surgeries mainly on Saturdays and Sundays. Now, as you can see, this is not a huge market. I mean, compared to the private acute market of almost 7 billion, we're talking about a market which this year is 100 million. But it's a market that has grown at 50% CAGR over the last 2 years, and we expect it to continue growing at almost 50% CAGR in the next 2 or 3 years. These are companies like 18 Week Support or Medinet. There are another 2 dozen or so companies that are involved in this space. Next slide, please. Well, I think that's all I have to say today.
Victor, thank you very much for that. A lot to take in there, some very interesting statistics. I suppose one thing that immediately comes out of the issue around waiting lists is how long are they going to go on for? You look at those numbers, 12 million people, we yet don't know how many more people haven't come forward. Do you have a feel for that? I think there was an initial feel that waiting lists could be brought down in a 5-year period. Does that mean that we have a 5-year uplift in the private hospital market and it will tail off, or will that be 10 years? Do you have any feel for that?
Well, I mean, how bad can it get, right? I mean, I think it really depends on the government will to bring it down. And frankly, with the new health and social care levy, it depends on us as voters to decide how much we're willing to put our hands in our pockets to get this waiting list down. I mean, well, look, does anyone really think that health and social care levy will stay at 1.5%? I mean, I think VAT started at 5%, right? And now it's 20. And it's clearly going to go up over time. And I think it will depend on the political hue of the government. Conservative governments very rarely bring waiting times down, it has to be said, except maybe, a bit of extra spending just before an election, just to make people feel good for a little bit. It's Labour governments that tend to bring waiting times, significantly down. And also, how bad can it get? I mean, in Ireland, the public waiting times for cataract 3 years. Here it's closer to 5, 6 months at the moment. It can get a lot worse, frankly. Yeah. And as I said, what do I actually think? I think this government is in a very powerful position. I think they'll probably win the next election as well. And therefore, I think waiting times, I think we're going to have to get used to quite long waiting times in the public sector for some time. And that this is probably good news for private hospital operators, and for this Parliament and probably the next as well.
Yeah, thank you. Well, we had to grapple with that earlier this year when we revalued the Nuffield portfolio, and we were looking at and discussing with them their forecasts and projections for the next few years, and had to have that discussion around whether it's a hump or whether it's long term. And I think as 2021 has gone on, probably we've all begun to realise that we all thought. What we're seeing, I think, in the transactional markets at the moment is very much reflecting what both you, Victor, and William have said. And we are seeing a great deal of interest from the investment markets in the private hospital market, and everything that you've set out, Victor, suggests that's one of the places to be. I think also we've seen a rise in interest in mental health and children's services and some of the specialist areas that William highlighted as not having been affected too much by this period of COVID. Yet we are seeing, of course, considerable disruption in the care home market. We very gladly, I have to say, are seeing much more activity in the care home sector with regard to buyers and sellers. We are seeing run rates in some care homes, EBITDAs and occupancy levels now returning to where they were, but some are being very slow indeed. And I do think, and we've always talked about the tail of poorer quality assets in the elderly market, and that doesn't mean poor quality care, but it does mean poor quality assets. And I do think they've been hit very badly during the COVID period with occupancy levels, and some of those will be very slow and may not come back at all. And I think we might see an acceleration of part of that market leaving the sector overall. William talked about an increase in numbers of care beds potentially being needed. We're hearing in the market that investors and developers and operators are a little bit jury out on that one. I think we're in a position where some people feel that extra care has come through COVID very well as an appropriate accommodation to look after people and to keep people safe. I think there is a general perception perhaps in the marketplace that care homes had more problems than they really did in some instances in looking after people and isolating people during COVID, and they rapidly got they got through those early stages and put procedures into place which helped enormously with the safety of residents after that first wave. And we're seeing now some of that bearing fruit with being able to show to relatives and to show to residents that care homes really are safe places for those that need 24-hour care. But interesting also to see these statistics on home care, William, because we've seen an increase in interest in the home care sector, perhaps not empirically in the first instance, but the gut feel of people to say that, well, maybe more people will keep their relatives at home, and they've been doing it for the last 12, 18 months, and maybe they feel they can continue to do it. I think there is a little bit of a sentiment that some of those people that have been working at home and looking after their elderly relatives won't be able to do that as the economy get back to normal and people perhaps go back to their office or back to full-time work off furlough and so on. So we will yet to see how that will come through. But there is this feeling perhaps that home care will take over to some degree from some element of care beds. As you said, we've seen a stable number of care beds over many years now, which is counterintuitive to the extent that we've got more elderly people needing care. So why a stable level of beds? And that has to be because of the other alternatives. And there is a question on tech, which I'll come on to in a moment, which may be part of that. So in 2021, in the transactional markets, we've seen more coming to the market, but not a huge amount. We've seen a few more care homes. We've transacted on care homes this year. We've got more, I hope, that we'll complete on before Christmas. So going concern, trading assets in the market are trading. We've seen a very positive primary care market over this period, and yields going down a little bit, if anything. The investment markets always take a flight to quality, I think, when markets get tough. The primary care market, backed by government income, has been a very safe place. We've seen development increase a little bit in that sector as well. Yields, as I say, have fallen a little bit, but we're also seeing some other positivities in that sector, as I say, around more development, but also around which is helping landlords in a sector where landlords are under huge pressure in rents. In other sectors, we haven't seen any rent default. We haven't seen any temporary rent reductions in that sector. And I think that will be a sector to watch going forward into the future. We now have, we have a very good insight into all of that business, working with the funds. Some of the funds are restructuring and repositioning themselves and will put some of their assets into the market, which will allow other operators into the sector as well. So primary care, I think, is going to be very interesting. I think the private hospital market is going to be incredibly interesting. The specialist areas are going to gather pace, I think, as people look at the statistics that you've set out. I think we'll also see some increase in things, and Victor, maybe I'll come back to you on this one, but diagnostics and splitting things out from central hospital, coming back into town centres with the huge opportunity there is for healthcare development to help regenerate town centres. We're working on 5 or 6 projects in town centres now, repurposing space from retail or offices, and I can see a lot more of that. We've got clients looking much more at the urban environment for extra care. And how extra care can be brought into town and city centres to play alongside all of the other services that are already there and to help regenerate the high streets. So I think we've got a huge amount to look forward to in the healthcare sector. Most investors are saying that they will stick rigidly to their returns that they require. They're not going to jump in, which suggests to me that we won't see vast price escalation in the sector, but we will see competition. And we will see a limited supply, I think, for the next few years in the very best of these segments. So we might see some price escalation. We might see some yields coming down. We will see some of these challenges play out, and we will see how the sector will deal with massive issues around staffing that you've both talked about, both in the NHS and in the social care environment. And there is a question I'll come back to in a moment that somebody has asked around how we deal with staffing. So have that one in mind, gentlemen, please, and I'll come back to that. But the whole pressure around staffing may just change the landscape a little bit. And I think we're going to have to watch which sectors are going to be most hard hit by that. And we will have to see whether the government, not only in terms of more money being put into the sector, but will it have to do things like it's just done in transport with the lorry drivers? Is it going to have to find ways of reversing some of the Brexit issues? So lots to play out. We've had a very, very busy 2021, but perhaps more important than the transactions that we will do, the exposure we, and I'm sure other consultants, have had to the whole of the sector that now wants to get on with life is probably the most important thing of all. We're hearing what investors, developers, operators want to do, and we have to be forward-looking here. Valuation and pricing in the market has very much been based on comparable evidence, but there's been virtually none of that for 18 months. And I think we all have to be forward-looking, and we have to look at the research that you're producing to help us to be forward-looking. We can't be backward-looking to the last 18 months. It is entirely abnormal. So your research is going to be hugely valuable to us. We're going to have to help the whole of the sector look to where it places its investment and how it takes its businesses forward. And as I say, I think, all round 2021 has been so much better than 2020, and 2022 I think is set fair, so long as we don't get any further variants or issues with COVID, and let's all hope that the vaccines and the boosters do their job. So that's kind of the house view from Avison Young at the present time. Thank you for listening to that, and let's get on to questions. We've got about 15-16 minutes left, I think. So that first question, how is this sector going to deal with the staffing issue? Can either of you see movements within the sector or within government at the moment, which is going to put some initiatives into place? Maybe William, can I come to you first?
Well, all I can say is reiterate how difficult a problem it is. And think of it this way, look, care staff are badly paid. Every extra £1 an hour that staff are paid would add about £600 million to the bill. The Labour Party is debating, I believe, today, moving the minimum wage from £10 to £15, which might seem very reasonable, but that would cost 5 times 600, £3 billion. Look, it's enormous, but perhaps the way forward is perhaps better staffing models. We have experimentation in the home care sector on using the Bruto, if I'm pronouncing this correctly, Bruto model of self-managing nursing staff who claim to be able to, with this model, prevent a lot of activity. So that's one way. There are other ways of doing it. There are outcome-based models in home care. Difficult to find another model for care homes, because care homes need a certain staffing requirement. So look, I have no answers. I'm afraid I'm just going to say it's extremely difficult.
Yeah, Victor, anything to add? I mean, I don't think anyone's got any answers at the moment.
No, I don't think I have much more to say to that.
No. And what about technology, Victor, both in the private healthcare market and more generally in the healthcare sector? How at Mansfield Advisors are you taking discussions in the tech world forward, and how are you advising people on where that has its best outlets? Well,
technology is probably the most exciting part of acute healthcare at the moment. It's mostly app-based. All these apps like Babylon and Ada and things like that can check your symptoms and tell you there's something seriously wrong with you, or connect you to a doctor. Problem is, of course, that there's so many apps, none of them are profitable, and frankly, they'll probably remain unprofitable for 5 to 10 years. But whoever is left after consolidation will be very, very large and important. But right now, it's not really investable for our clients who want to have actual profits. It's a very exciting area for venture capitalists and people with that kind of risk profile. Yeah. Interesting.
So yes, so maybe slowly coming to the fore, little by little. William, do you think that will be a catalyst for seeing not a rise in care beds in the care home setting, and more home care, whether that's in extra care facilities or in own home?
That could be, and that is what is being claimed. I was interested to note in the chat that's coming through that one of the participants was talking about digital technology as a means of nudging individual behavior. There is possibly something in that, though I'm yet to be totally convinced. Certainly, I would see digital technology in home care and care homes indeed as, first of all, assisting with back office functions, which is important but a bit boring. But it certainly has a role to play in the quality of care, but it isn't there yet. It's not there yet by any means.
No. Yeah, and you mentioned chat there, William. Do please all have a look at the chat that's going on, because there are some interesting topics being raised there. Another question that came in, Victor, revolves around the best ways to engage with commissioners in the new ICSs. What are your thoughts on that?
Well, whenever we have an NHS organization, one lot of commissioners goes and another lot replaces them. And then they spend 6 months, working out what their job is and how much power they have. I think the truth is that, the ICS change is evolutionary rather than revolutionary. And hopefully that, for your commissioners, they won't change too much. Or you'll see familiar faces appointed to slightly different roles in ICSs. But how do you engage with them? And I guess it's the old-fashioned method of trying to go and see them and having coffee with them. It is a problem though, because unfortunately a lot of commissioners just don't want to see us.
Yeah. William, same question. And what are you seeing there?
Right, well, the ICSs are supposed to be integrated care systems. They're supposed to achieve what has not been achieved for the last 40 years, that is some sort of integration, not only of health, but health and social care. There are some areas which are just crying out for integration. I mean, again, looking at the home care sector, why is it that we still have people providing home care funded by local authorities going around? At the same time, community nurses are going around doing very similar jobs. It just cries out for some sort of integration. I mean, just looking at it in terms of possible market potential, but a long way off yet. What about the example of traditional home care for local authority funded, low-paid staff traveling around visiting, and the other side, which is the high-tech clinical home care? You could possibly imagine with integrated care systems really looking hard at this, that sometime in the future, you might actually find the two ends joining together. Now, clinical home care is one of what we're talking about, what are the fastest growing areas in independent healthcare. And in fact, clinical home care, that is people providing basically nurse delivered medication, has been a hugely rapidly growing market in the past. It's approaching £3 billion at the moment. So there is potential out there, but will the integrated care system actually be able to sort of consider the possibilities that are open to them involving the independent sector when the zeitgeist is so much against independent sector at the moment? I don't know.
Thank you. Victor, one for you, I think. Do you know if the growth in the health insurance market is predominantly for guided care?
Well, I expect this means guided referrals, where basically the member has less influence or less power to decide which consultant sees him. I can't really say that, really. I mean, that's mostly a Bupa product, isn't it? And if we saw in the latest research that Bupa shares were, Bupa market share was going up, then maybe the answer is yes. Maybe William, who is doing this research, can expand a bit further.
No, unfortunately, we can't comment on the relative values of individual insurers, I'm afraid.
Okay. A very broad question here. How can we make government pay fair price for care? And I don't know what that was directly looking for, but I guess there are two questions there that I would have with that to you, Victor. Any sense of what the government will pay to private hospital operators for helping with the waiting lists, and how profitable is that? And to William, I suppose, you've sat in government select committees. You sit on think tanks, you speak very broadly on the subject. Is there any way that all of the statistics available can put pressure to bear on the government to assist further? So Victor, you first, if I may.
Sure. I mean, look, essentially, we have an economic situation which is not a monopoly, but a monopsony, where you have one dominant buyer of services in the UK. And obviously that dominant buyer has a lot of pricing power. And unfortunately, care providers, when they're selling to the government, are more likely in the position of price takers rather than price price setters. The only time that you are really a price setter is when there's such a shortage of your beds that the government just has to pay up. And we saw that in the early noughties in mental health provision, for example, where mental health beds were going up in price by 8% per year between 2000 and 2006, and which were great years, for those of us who remember them. But fundamentally, it is a monopsony. Now, in terms of what does the government do in terms of thinking about pricing? They do hire consultants to look at the impact of various actions. So, for example, a consulting project that will be familiar to many of us in this call would be one that the Department of Health did, looking at what would happen if we did this. How many companies in the sector would go bankrupt, frankly? And the government does do lots of econometric studies to look at the impact, but fundamentally, they're not really there for you to make a big profit. I mean, they're trying to squeeze down profits in the industry.
Yeah, and we're running out of time, William. But briefly from you on that subject, with your experience, how does government get the message?
It won't until, as Victor says, a disaster approaches, and then it might.
And then it might. Yeah. Okay. Thank you for that. We have a question just asking William, when will the report be available, and how much does it cover of 2021?
Right. You've caught me out there. I'm afraid I'm not sure exactly. It'll be available. It should be available within the next week. Okay. But I don't actually know, which I feel very bad. How much will it cover 2021? Well, look, there are some elements of it which are forward-looking. I've tried to focus on those, but obviously, for the most part, the statistics have to be backward-looking. There are some projections, but I cannot claim that this is a totally forward-looking report.
No, but I noticed you've got some year-end December 2020 accounting information in there, so it very much depends. Very much depends on when year-end is for the different different operators. So there's an element of it within there, and very useful it is too. So we do need to finish there. There are questions, I'm afraid, which we haven't had time to answer. But look, thank you everybody that's been on this today. For all of you who may see a recording later, thank you very much for that. If you have questions of any of us, I'm sure you can find us and ask those questions separately. But Victor, thank you very much for joining us today. William, thank you for your insights and for allowing Avison Young to sponsor again this year. And I hope we see each of you and all of you participants today again very soon. Thank you all very much for joining.
And thank you, Ian, too.
Thank you.